Hey everyone, thanks for joining us again today talking about options. So again, new material for 2019 added into the curriculum. We used to talk about options in CMT1 and that's been moved to CMT2. So depending on when you did CMT1, this may be a little bit of a repetition, still worth watching. It's a pretty short session, so worth watching for a review and to make sure that you're very familiar with what you need to know for this exam. All right, so the key points of what we're covering is explaining the purpose of option markets, list the major terms of options contracts, defining the Greeks and what they all are, and then defining implied volatility as well. Now, implied volatility, we're going to talk about that in detail in the next session from the original curriculum. I'm not sure why they're adding it into this curriculum, this chapter as well, but we'll hit the points. It'll be a good revision, but there'll be much more detail in implied volatility in the next chapter and the next video of the course as well. All right, so options. Basically, options are the right, but not the to buy or sell a security. So, typically when we talk about share options and options for buying Microsoft shares or things like that, a single option is the option to buy 100 shares. So they're always sold in lots of shares, etc. Now, the best analogy that I've ever heard for explaining an option, if you've not really looked at this very much before, is to imagine that you paid $1 for a pizza coupon. So we've got a pizza coupon here, and it basically means that we can get a pizza for $8.99. And it's a 5-star pizza, so it's probably great value. So let's just say we paid $1 to get that voucher. Well, that means that I have the right, but not the obligation. I don't have to go buy a pizza, but I've got the right to go and buy a pizza for $8.99. But it is before January 15, 2017. So that's when this coupon expires and is worthless at that point. So if pizzas drop to being $5, well, then I wouldn't use my voucher. I wouldn't use my option to buy a pizza. I just go to the shop and buy it if I wanted it. But if pizzas went up to $10, then I definitely would be using this. I'd be 1 cent in the money. Because when I talk about, obviously being in the money, it's not just the value of pizza against the value of my option, but it's how much premium did I pay as well. If they went to $12, then I'd be a lot happier, of course, as well. So again, it's just a great way to understand something that we're a little more familiar with. So options are derivative instruments because their value is derived from the underlying security. Options on the S&P 500 futures are derived on the cash price of the S&P 500 futures. This is where that gets interesting because the options on the futures are a derivative, but the futures themselves are a derivative of the actual S&P 500 index. So a lot of fun there. Options on things like shares, obviously derived on the share price. Option value decays because it diminishes as time gets closer and closer to the expiry. So going back to our pizza, even if pizzas were, let's say they were $8.99 and I was sitting 3 months out, I may look at that and say, you know what? I want to buy 5 of these, 10 of these. I'm happy paying $8.99, and I've got a funny feeling that pizzas are actually going to go up in value in the next 3 months anyway. So, that's worth buying. But if the expiry was tomorrow and pizzas were $8.99, well, I wouldn't spend $1 buying an option. It wouldn't make any sense. So it decays in value as we get closer and closer to the expiry date. Unlike an equity, which is subject to supply and demand, options have many more inputs. So yes, there's a little bit of supply and demand. If there's a lot of demand for an option, it can have an effect on its price, but that's not really where the pricing comes from. It's more to do with the stock price the underlying price of the security, the strike price, what's that face value on the option, how long till expiry, what's the volatility of the market like. When we get into volatile markets, option prices increase. And the reason for that is that there is a higher probability that we're going to reach or move a long way away from where we currently are, or reach the strike price and things like that. So that increases. See, part of a options value and the leveraging of it is because there's uncertainty about whether the market will go up or will go down. And so if you're buying a call option, which means you're expecting the market to go up, maybe it won't. And so there's uncertainty. When there's a lot of volatility, we are sort of thinking, well, yes, it is likely that the market's going to go up. And so it makes the option more valuable because there's a higher probability that the option writer has to pay out on that. Interest rates affect it as well. Rising interest rates will push call options higher and puts lower. And again, that's more to do with the value of money and holdings. I really don't think you need to know the reasons why necessarily on these things, but definitely do understand them. Dividends affect, obviously, because they'll factor that in if a stock's going to pay dividends in the option period before expiry, then there is usually a bit of extra premium there. So all of these are usually processed through options pricing modules as well. Now, the text does talk about the Black-Scholes model, etc., just in passing. I really don't think you need to know anything about any of those models. It's sort of a bit beyond this level here. You'd have to do a very dedicated options course for that. So a couple of main option strategies. Now, again, in the text, they touch on this and then go into separate data and then touch on it again. I've brought it all together. So, our first strategy is leverage and speculation. So typically this is just buying and selling options, not because we're trying to protect anything, but we just want to have leverage in the market. So, because that option has exposure to 100 shares, and the shares go up, we can get exposure to that capital gain without having to buy all the shares. So for a lot less money, we can do that. The other things we can do is make money in all market environments, bullish, bearish, or even neutral. As when we have markets which are neutral and volatility is dropping and dropping and dropping, we can actually create option strategies that take advantage of rising volatility without there needing to be a bear or market reaction. It's just the fact that the volatility's got bigger and you can profit from that as well. So again, there's quite a complex strategy that can profit from an opinion without taking a position in the underlying. So if I really felt that the market was going to go down, that's my opinion, I've got no proof of it, well, I can take a put option, I can buy a put option on that and profit from that without actually having to short sell shares or anything like that. Highly leveraged can gain price exposure for a low initial cost. Option traders can also benefit from changes in volatility since it affects price. The other main strategy, so this is the speculation, the leveraging, getting exposure to bigger position sizes for less capital outlay. Hedging as insurance for investment. So if I've got a large portfolio, or sometimes I may have received a share as part of an inheritance, and if I were to liquidate that share, the taxation implications would be huge. Well, instead of liquidating, in times of real pessimism, etc., I can just buy a put. So if the market goes down, well, I'm still going to profit from that put. And, I may have to fund that. So particularly, well, that's if I was writing. If I was writing an option, I would definitely have to fund it. But the puts act like insurance. So here's where it gets a little bit confusing, because while we have calls and puts, and we'll talk a bit about that in a moment, we also can have a buyer of a put and a writer of a put, or a seller of a put, and then a buyer of a call and a seller of a call as well. So we've got to keep all of that clear in our heads. When it comes to hedging and insurance, you never really have to deliver because you are putting the put out there and you can sell it before expiry. You see, because of that expiry date, you only have to transact at expiry. So if before the expiry actually happens, I find someone else and I say, hey, I've got a put, you know, the S&P's down at 1500 and I've got a put when it was at 2000. Do you want to buy it off me? Lots of people will do that. So again, from a PM point of view, I can protect my portfolio and I can take all of that profit up, which, you know, would have probably been offset by a lot of the losses that my equity portfolio made, but I'm still neutral in a downward market by using that protection. Mitigate the effect of down markets without triggering capital gains is essentially what that is. All right, so puts and calls. Now this traces all the way back to the 1600s and the Holland tulip bulb mania. So in February 1637, the bottom fell out of the market and there was panic and there were futures contracts in place. The self-regulating guild of Dutch florists basically said, hey everybody, you don't have to fulfill your futures contracts. If you pay a fraction of the price, you can convert it into an options contract. And that means that you've got the option to fulfill it if you want, but not the obligation. And that was one way that they got out of it. And as strange as that sounds, that they can go and change futures contracts like that, you know, that ended up getting ratified by the Parliament and went a long way to sort of helping them get out of that mess that they were in. So essentially the futures were converted into options. Wholesalers were hedging risk by buying a call option. So, you know, if you were going to market, etc., you know, you wanted the call option there as well. And then the farmers were locking in profits with a put option as well in that. So remember, calls meaning that, let me say, at expiry, what would happen is the wholesaler would call from you. So if the wholesaler was initiating the transaction with a farmer, you know, they would want to call from them, you know, the bulbs promise. So the farmer was putting the bulbs out and saying, yes, I've got this agreement, I'm going to provide this, and the wholesaler would do that. If the farmer was initiating the deal with the wholesaler, they'd be putting the bulbs over to the wholesaler. So, you know, that's the way it goes. And again, that same relationship with the wholesaler to, you know, the end consumer. Well, the consumer would call from the wholesaler, but the wholesaler would put to the consumer. It all matters on who's initiating the transaction with all of that. As far as the exam goes, remember that a call is the right, but not the obligation, to buy shares at a predetermined price. A put is the right, but not the obligation, to sell at a predetermined price. And so I think that's the main parts there. The value of an option is made up of two components. There's the intrinsic value, which is basically the difference between the strike price and the share price or the security price. You know, that's it. You know, when it's in the money, meaning that the strike price for a call is below the actual price of the market, then, you know, we say that's in the money. If they were equal or around equal, it's at the money. If it was way below, so if we have a call and we've got this option to buy Microsoft shares at $70, but Microsoft's trading at 50, then we say it's out of the money. And we would never exercise anything that's out of the money. Obviously, the further you get into the money, the higher the intrinsic value becomes as that goes. Now, the other component is time value. Remember we said that, you know, there is that thing of, if I think Microsoft may come back up from 50 to past 70, I may actually buy a $70 call, as long as it was a long way away and I felt that the market would come up. Now, because there's no intrinsic value, there's no reason why I would buy that, because right now that option is going to lose money. What I'm buying is actually the time value And so it's the difference between the premium, the cost of the option, and the intrinsic value is what you would call the time value. In this fact, when there is no intrinsic value, in the example that I just said, well then it's all time value that you're paying for. Typically options with the same strike price, but expirations further into the future have higher prices because we expect that, the probability that it comes up again in that time is more likely. The more in the money an option is, the higher its intrinsic value. Out of the money options have no intrinsic value. That's obvious. So the buyer and the writer. For there to be an option to buy, someone needs to create or write the option. Writers fall into two categories. You have covered, meaning that they actually have the shares to sell. So if I'm doing a call, it means I've got the stock. I've got the stock there to fulfill my side of the obligation as a writer of that option. So if someone buys a call off me, they pay me the premium for it. Usually if I'm writing a call, I'm doing that because I want to get some more income from my portfolio. It's a sideways market. I'm not getting capital growth, not many dividends. Right, let's do covered calls. If the market stays sideways or goes down, I'm going to collect that premium and that's nice income for me. If the market goes up, well then I'm going to have to fulfill my obligations because the buyer of that call is going to want to buy my shares so they can sell it into the market or whatever. Put writers have the funds to buy the stock. So if I'm writing a put, which basically means I'm going to buy your stock off you at this predetermined price. So even if the market falls, I still have to fulfill that. Now, even if the buyer of my option on-sells it, whoever they on-sell it to, I still, as a writer, have to fulfill my obligations no matter what. Now that's covered, where I've got the funds, I've got the stock, etc. The naked call writing is a lot more speculative and a lot more dangerous, and it basically means that I have no ability to fund or fulfill my obligations. I'm completely expecting the market to go my way, and I'm going to make the money purely based on selling. I'm just going to collect premium off nothing. Very dangerous, but can be done, but not from the faint-hearted. If you had 100% certainty on the direction of something, well then, it may be an interesting way of creating a revenue stream. Writers profit from the premium, which is the option fee. It's a way to earn income in sideways markets. So when can I exercise American options? There's two styles of options, American options, European options. American options can be exercised anytime. But why would you? Because when you've got an option that expires in a month's time, there is the intrinsic value and there is the time value, which is that option price. If I buy an option and I exercise it immediately, well, all I'm doing is locking in the intrinsic value, but I'm throwing away the time value. So unless I really believe that the market was about to turn, etc. Now, I can sell my option. That's different from exercising it. Exercising means that I'm taking the physical, I'm fulfilling my option to buy the physical security. So, that's why I say you don't want to exercise. I can sell the option, because the market's going to turn, and then I'm gaining the profit from both. But American options can be exercised any time between the date of purchase and the expiry date. European options can only be exercised at the expiry date. But the options can still be traded. They can still be bought and sold at any time. Most exchange traded options are of the American style. So yeah, if I'm a call buyer, I'd go to the seller or the writer, and I'd say, I'm exercising my option, give me my stock. And the seller would say, that's fine, pay me the strike price. Remembering that the strike price is what I pay only if I exercise the option. The premium is what I paid to buy that option or voucher at the start. So a couple of examples, you'll see these payoff diagrams as well. Basically, again, just highlights that this is the stock price, higher stock prices over this side, lower over that side, and this is my profit. versus my loss. Now, right at the start, if I buy an option, I'm at a loss because I paid a premium for that option. But as the price goes higher and hits the strike price here, and then goes through the strike price, so as soon as the price is above the strike price, then my profit starts going up. And then the further and further that we go up, obviously the deeper into the money we get, the higher my profit will become. This at the money part is anywhere from my strike price to where I would have recouped my premium, is what we would call at the money. So the time value there, we can see is basically this slope here. This is the ideal case or theoretical case. This is actually what normally happens with price as we go. Now, when you look at all the different strike prices for a period out, let's say 6 months out, the curve will look more like that as we go out of the money, into the money, etc. And so that gives you an idea of the time value, because that's the extra value that's being added by buying an option that's further out in time. And the intrinsic value, as we said, is the difference between wherever we are on this line and what the strike price is. Time value shrinks as we get closer to the expiry date, and that blue line would start to squash in, and basically right at the end it overlaps the red line. Can still have time value even when there's no intrinsic value. You will still pay for an out of the money option. Okay, so the call writer, so the other side of that transaction. So obviously this person makes money as the stock price goes up, but the writer, they make money immediately on the premium, but as the price goes up through the strike price, now they start to lose money. And they have to pay that out, pay and fulfill their obligations, etc. Now again, lose money is a relative term because they may have bought that stock much, much lower, and so fulfilling that obligation they're still going to make a profit. It's just that they're not going to realise the further gains in that stock price as it goes. If it's covered, the losses missed potential profit. Their options are that they can, pardon the pun on that, but their options are they can buy a call to offset the loss. So if they see this happening themselves, they may be getting to this point and saying, right, I want to buy a call, to offset the loss that I'm going to have for fulfilling this obligation. Or if it's covered, when it exercises, they can just sell out of their position or of their underlying. So now the other side of it is a put holder or put buyer. So again, in this case, we're buying a put, let's say at the money here, and price is going down this way and prices go up this way. If the price goes up, I make no money and I've lost my premium. But if the price goes down, once it goes down below the strike price, I start making money again. So it's really the inverse of what we saw before. In the money are obviously below the strike price there. Again, we have the time value. As we get closer, that will squash in, etc. Put writer, again, it's the opposite of what we had before, where the put writer will start losing money if it goes down. But then they could buy a put to offset that, etc. So it's just the inverse of what we had before. You can have a put buyer with underlying. Should have taken this slide out. Don't worry about this one. It's not part of the curriculum in CMT2. This is really just sort of saying that if you have the underlying, buy the underlying and sell a put on it, what does the payoff look like? So option effects, again, there's a number of things which are influencing option price. It's the share price, it's the strike price, it's the time to expiry, it's the volatility, and it's the interest rates. And so when share price increases, then the value of calls increase, but the value of puts decrease. When the strike price increases, so we buy a option with a higher strike price, well, that would decrease our call value, but it increases the put value. Time to expiry, they both increase. Volatility, when volatility increases, they both increase. Well, sorry, time to expiry, I sort of have to say increase, but the reality is that time can never increase. It actually always decreases to expiry. So the reality is that we would invert this, and as time to expiry decreases, call value decreases, put value decreases. Interest rates cause calls to increase, but puts to decrease. So some terminology, we've got 2 pages of terminology here. Print them out, stick them on the wall, make sure you know all of these. Call option, the right but not the obligation to buy a security at a certain price by a certain date. Put option, the right, not the obligation to sell a security at a certain price by a certain date. Expiration, the date at which the option holder no longer has any rights and the option has no value anymore. Premium is the price paid for the option. The strike price, this is the price at which the holder of the option may buy or sell the underlying security. So a couple of examples there, I'm pretty sure you get that. Open interest, the number of option contracts outstanding per strike expiration. So, normally the strikes are at pretty even intervals, so $50, $50, and usually 50-cent intervals, most of them are. Sometimes around dollars, it depends on the value of the underlying. But you look at that and say, right, how many $50 options are there 3 months out, 6 months out, 9 months out? And so that's the open interest that we have there. It's the unfulfilled options that are out there. Exercise, using the rights acquired under the option to buy or sell the underlying security. In the money, we've talked about that before. When it's a call, it's where we have a strike price below the current price, or if it's a put, where our strike price is above the current price, meaning that we're going to make money off the option. Out of the money means that we're not going to make money unless we can convince someone to buy it from us for its time value. At the money, strike price is at or very close to the price of the underlying. Implied volatility is the calculated expectation of future volatility. Now, implied volatility is usually calculated from an analysis of the puts and the calls. And we talk a lot about that in the next chapter in the course. So we'll talk more there. Options writer, a writer creates a new option by selling to a buyer. Writing and selling are used interchangeably. So sometimes we say an option writer, sometimes we say an option seller. It's the same thing. Although selling to close out a position is not called writing. So I can buy a call option. Now there's someone out there who is the seller of that call option. But if I sell my call option, that's not called writing. I bought it from a writer, and then I've gone and sold it from someone else, and the transaction is going to be between the writer and that new person who bought the option off me. But again, that's not writing. American style and European style we talked about before. Then we have the Greeks. Now the Greeks are, you hear them talked a lot about options, and they're just different ways that we measure and compare options to each other. So delta measures how much an option changes. So looking at the option price, the value of the option measures how much the price changes for a 1-point move in the underlying security. Ranges between 0 and 1 for calls and -1 and 0 for puts. Gamma measures the rate of change. So it's like a second derivative, like acceleration to distance. You've got distance, speed, acceleration. Well, we have the price, the delta of price, and then the gamma, which is the acceleration of the changes in price. Theta measures the rate of time value decay. So how quickly the price is dropping for every day, as we're getting closer and closer to the expiry. Vega measures the risk from changes in implied volatility. So if there's a change in volatility, how does that affect the price of our option? And so it's a measure of that. Now again, the curriculum as it stands doesn't require you to use these calculations. It just requires you to know what they are. So you don't have to go through all the math and all the fun of like the Black-Scholes model and things like that. Rho is the last one. It measures the impact of changes in interest rates and option prices. That doesn't change all that often. You know, we don't get interest rate fluctuations all the time in the risk-free rate. And so, you know, we don't really see that number changing a lot. Nevertheless, it's still part of the inputs to most models. And so it's one of the Greeks that we do keep an eye on. Implied volatility, as I said, you know, there's a section in here. Basically, you know, I just put the notes down, make sure you know these, but we're going to cover all of this in the next chapter anyway. So implied volatility is the estimated volatility of the security's price. It's an estimate of future volatility. We talk about historical volatility, which measures what happened in the past. Implied volatility is the volatility that's being implied by the options behavior. And so it's what we expect to happen in the future. So if suddenly lots and lots of people buy put options, then we're just like, oh, hang on, something's going on. We're implying that there's going to be more volatility in the market because of this options trading volume that's going on. And so, you know, we're implying, but it's not a fact. We don't know that it's actually going to be that bad until we get there and see what fluctuations happen to price. Implied volatility tends to increase when a security is bearish. Bear markets are considered more risky. You know, when we're in a bear market, we get big drops. And so, you know, whenever we are in a bear market, volatility does increase, and implied volatility is higher than when we're in a bull market. Implied volatility does not predict market direction, only forecasts potential price swings. Talk more about those calculations in the next chapter. And it's denoted by either vol or sigma there as well. All right, so that's options. Again, I think for many of you, it's probably just a refresher. But just make sure that you understand why options can be used, the leveraging or speculation, and the hedging. They're the two main ways that options are used, so make sure you understand that. Make sure you understand all those terms. Print out those sheets. Print out the sheet on the Greeks and make sure you memorize those as well, and make sure you understand implied volatility. But again, we'll talk about that next time. So thank you.